and thank you for joining us today, wherever you may be, from Accra to Addis Ababa, from Durban to Dubai, from Cape Town to Cairo, and Kolkata to Karachi. Thank you for being here and taking your time. Yes, we always have an intro like that. Thanks so much for joining us. My name's Adrian Bradley, and my colleagues Desiree and Chris are on the call with me in the webinar. We'll be having a very interesting chat this afternoon about alternative investments and diversifying your portfolio. I'll run a little bit of an MC, but if you've been on these calls before, you'll know we really have a bit of a team game here, where we all just have a good chat about it and see where the whole presentation takes us. So without further ado, I'm going to just share that, and we can get going. From my perspective, it's just a greeting from us, and from a Holborn perspective, just to give you background about who we are and that we're licensed from a regulatory perspective. And then on the agenda today, it's going to quickly call that up, but essentially just an introduction to Holborn. We're going to tell you about alternative investments, what they are, then overview. And always in these type of things, I think a practical example is something that's far easier to understand for people to get a grasp of how it actually works, rather than sort of facts and figures and flying around on the theory. So that's what we're going to do. We always start off with introducing ourselves. So from an introduction perspective, I'm going to see how the slides randomly called up my colleagues. And who's next? Well, it's going to be Chris. So Chris, far away, mate.
Yeah, hello everybody. Thank you for joining again, as always. We'll try not to bore you to death again today, but yeah, I think you figured out by now I'm from the UK originally. Been in Africa now for 8 years, originally in Zimbabwe and then in Ghana. Before coming to Mauritius, and I cover now the whole of the continent primarily. Yeah, just helping individuals with anything to do with their financial planning. And this one in particular today is something that's very, very popular right now. So yeah, hopefully you'll get some value and some benefit. Over to you, Desiree.
Desiree, yes.
Hello, everyone. Okay, so that clearly says African specialist in financial planning and management. And I constantly get questions about what brings the African part in, but that's because I'm Zimbabwean, and proudly so. Been working in Africa, like Chris, for the last sort of 7-8 years. Really, really excited about today's webinar, actually, because I think this is an excellent opportunity for so many of our clients. Over to you, Adrian.
Yes, it is over to me, I think. Yes, it is. Okay. More or less the same from me. I've been a wealth advisor then in the investment advice space for, well, the financial services space for, it's touching nearly 20 years. And the individual advice space for 7 or 8 years as well. Funny enough, the same as Des. And really, the holistic planning is my speciality. It's sitting with a client to just see where they're at, what they need to do. I'm a certified financial planner, so a lot of it is setting goals and targets for yourself or for your money, and that's the kind of thing that I do. So. Please reach out at any stage, before or after, and obviously clients that are watching will have a nice review as we go forward. I think the next little bit is for new clients or new people that have joined the webinar for the first time. What we like to do is obviously just talk about us, about Holborn. We've talked about us, but then we like to talk about the company that we work for. So I'm just quickly going to give you some background about the company Holborn and where we're at and what we do. We're essentially the second largest independent wealth advisory business on the planet. I like to say that. Maybe we'll send her over to Mars, and then we can say intergalactical second largest or something to that effect. But from that perspective, we're the second largest. We've been around a long time. Our CEO, Bob Parker, is still our CEO. He founded the business over 20 years ago, and it's still proudly family owned. His son Simon also is part of the business, and really that gives the personal touch, and one of the main reasons that myself personally I joined the business. As I said before, they're second largest globally. We have about 13 offices around the world, 15,000 clients, and another big thing out there with the 13 countries is that we've got about $2.5 billion US dollars under advice, and that's a sizable chunk, and again, as I say, makes us the second largest. And what do we do from an advice perspective, or what kind of things do we talk about to our clients? And essentially, as the three of us have said, we just sit with the client and we can find a solution in for most of their needs. So I'm not going to go through all of these in details, but essentially you can see we do anything from pensions and trusts across to mortgage lending, citizenship for investment, and the final one there, which is the one we'll really unpack today, from an alternative assets perspective, is something that we do. The other reason that the other slide that I'd like to just quickly go through is why people actually work with us. We don't do a lot of above the line advertising, but as you saw from that first slide, we've got about 15,000 clients, and we're very proud of the fact that we have that many clients that work with us, and we work with. The size is easy, as I've said to you before, being the second largest advisory business in the world, that allows us opportunity to talk to product providers and ask them for commensurate terms of business that a retail investor would not get, and we pass any of these savings and the charges that we get across to the client. We're independent. So that's a very, very strong pillar that Bob started the business with. So we're not a tied agency force. We're not owned by any individual company or a life company or anything like that. So really, from our perspective, we give the client the best advice and the most impartial advice as to what's available out there in the market. From a client service perspective, we're also very proud of the fact that we have a strong client service focus. And as you can see, we consistently winning awards. I couldn't put them all up there, so I just put last year's. But we consistently win client service awards for looking after our clients, and we're proud of our Trustpilot score, please, and we welcome you always an independent review to go to Trustpilot and just have a look at the scores that clients have given. Safety and security is also tantamount to us. I think on the first slide you would have seen that we're a business that's in the 13 different countries, so we operate in regulated environments, and that's very important to us that we are providing advice in the right place. And then education is our final pillar that we always pride ourselves on as advisors. So we're constantly looking to increase our knowledge or keep our knowledge up to date. And that's another prerequisite of being an advisor in this business. Bob has a nice high standard, and we're expected to keep our qualifications current, up to date, and it be improving as best we can. So that's the 2 or 3 minutes on Holborn and the current clients that are on. Hopefully, if you haven't done a Trustpilot score, please go and do that. Go and fill something in and make a comment and give some feedback. The next thing that we're going to talk about now, after that boring not boring, that long-winded thing, is let's get down to the nitty-gritty. So I think alternative investments is the topic of the day. What's that?
Was boring. Let's do the good bits.
Yeah, let's get to the good stuff. Great. Alternative investments. What are they? I mean, which of you? I've talked a lot now. Who's going to take this one? Des?
I'll take it.
You'll take it. Go for it.
Look, alternative investments are basically assets that don't sort of fall within your conventional investment categories. So that would be your stocks, bonds, cash. So essentially, including anything like hedge funds, futures, arts, antiques, commodities, that kind of thing. Yeah, I think I answered that one.
You did. Fairly succinctly and quite quickly, so we can get into the meat of the conversation and get some examples.
Did you want me to carry on?
I was expecting the long textbook answer for passing a CISI exam, a couple of pages. Great. I think from our perspective, as I said in the beginning, the best way to kind of illustrate this and give the example and then have the discussion around it is an actual product that's available. We've got two we're going to talk about today, two product providers that we have on our panel. One is called Walton. I'm going to do a little bit of an overview about who they are, how it actually works, and then a working example, current availability. And then after that, we're gonna talk about another provider of ours called Acorn, and do exactly the same run through. I think for my sins, I'm what's the word? I'm going to be chosen to do Walton, unless someone else wants to jump in. But I think if you've been on these calls before, they're very interactive. We don't not interrupt each other or throw in our 2 cents worth together as the team. So I'll kick it off. From my perspective, Walton is a company that's been around about 40 odd years or so. And really what they do, they operate in the land space. So the land space is, and I see, sorry, I forgot to say in our boring bits that we're going to run a little poll. So we're going to run a poll while we're going through all of this. And please just answer those and we'll have a chat. See if we have enough time at the end, we can look at the answers that you've put in for the poll. So please do that. So back to Walton. Walton operates in the land space. So, and I'll give the example or talk through exactly how it works. But certainly land as an asset and an asset class is something from an investment perspective that really is something that's gold, if you like, excuse the pun. But property as an asset class is probably one of the safest and most secure asset classes that there are out there to provide slow and steady, consistent returns on your investment. And Walton operate in that space. They really look at finding parcels of land. This is their sort of overview, 2 minutes, 2 seconds, two lines. They basically look for a fully packaged US land solution. They publicly or they partner with publicly traded home builders, and I'll explain how that works in the process. And they then target somewhere between an IRR of 12 and 15% per annum. So a rate of return on your money at a nice, healthy 12 to 15%. And again, as they said earlier, from an alternative investment perspective, completely uncorrelated to what's happening in the stock market, with the shares going up and down. And really the distribution goes on. Yes.
Can I jump in?
Yes.
Could you unpack the IRR a little bit for people that might not really understand the concept?
Okay. I'll do it fast. I'll do the cool. You.
Can you also tell what type of alternate investment this is? Because you told us about many things, but I don't really understand what type of alternate investment this is, Desiree.
It depends, on which particular one we're looking at, whether we're looking at Walton or Acorn.
Are we looking at loan notes or?
Yes, we are. We're looking at property loan notes.
That's an Acorn, and the technical term on the Walton is a phased takedown approach. So I'll also get to that in the example. I mean, from my perspective, there's what I can quickly say on the IRR. That's a calculation and I'll do an example which will then explain how that works. But an internal rate of the IRR is a financial calculation called the internal rate of return. So in very simple terms, if you hand over $100,000 and you have an internal rate of return, the IRR of 12% in 1 year, you're essentially going to get $12,000 return on your 100,000. So that's the simple maths explanation of the internal rate of return. It's a little bit more of a complicated calculation because it's a time value of money, but then we're going to spend another hour on a webinar explaining time value of money and cash flows and all of those type of things. I like to just give it a simple explanation that way, but I will show it to you in the example just now. So on to the which type of alternative asset. This is a land asset that they don't do loan notes, but they do essentially what Walton does is it gets involved in stage 1 here. I'm going to just try and see if I can use my pointer. That always helps the process. So Walton start right at the beginning of the process. They essentially get what they call pre-development land. In this little picture, you can see it's almost like a picture of a map, and you'll see it also when I explain it. They essentially look and find and look out there in America. So they're American based. They look for land in America where there is pre-development work needed to be done. And what we mean by pre-development work, there's no basic services. It's essentially just a piece of farmland or close to a piece of farmland. So it's had no essential services added by the local municipality. It's had almost no zoning, so it's not zoned to take housing or anything like that. And then in the process of developing it, you can see here's the timeline of how the land gets developed. The home builder and the developer actually puts in the essential services, then a public or private actual home builder builds the home, and then the developed community thrives and moves. So that's how Walton is involved, and they're involved in that very first stage. So have they got a good track record? Absolutely. They've done a lot of projects. As I say, they're over 40 years old, and they have a whole lot of projects at different stages in development, where they have an offer letter or a phase takedown already happening. And those are terms we'll explain in the example. But essentially, they have a very good pipeline and a very good development pipeline, 6,000 acres. And really, they have an offering of circa 265 million at various stages of this internal rate of return. And I'll explain that as well in the example. The example is always easiest to give when you give one exact opportunity for a client to invest in. And the one that they have at the moment is a Keller tract in South Carolina in the US. It's actually on the border with Georgia, and it's here's South Carolina, as you can see. And why South Carolina? Well, it's a growing state. It's near close tracts of a port. So it's near the port of Charleston. Economic activity is high. Unemployment rate is very low, 3.5%. It's got a good labor force. All of the kind of things in a property space. And I think in a loan note, Chris or Des or all of us will talk about the drivers around property and why you need these type of things to make it valuable to invest in the parcel of land. And that applies to South Carolina. So essentially, it's on the border of Georgia. Here's Georgia, and in the space down in Aiken County, and here's a little picture exactly where the piece of land is. It's this little W here, as you can see, and downtown Augusta, Georgia. If any of you, Chris and I play golf, and if any of you play golf, it's a stone's throw away from Augusta, Georgia, from going to watch the Masters. So any golf players out there, give us a call straight away. You might have to go and visit your piece of land and go and watch the golf at the same time. But the overall,
I don't play golf. I try to play golf.
Sorry, I should have said that. Yes, we try and play golf. Yes, but of course you can, Chris. That's
I think that map's a great example of this. I think when you look at Walton's history, there's a lot of due diligence that goes into identifying this land, and it's looking at how existing cities and towns have, already expanded and where they're likely to expand to, and then it's acquiring, that land in the hope or knowledge if they would like to say that, a developer is going to come along and ultimately want the land that they ultimately own. But there's it's not just buying land, in random places. It's very well thought out, due diligence that they do. So I think that just highlights that. I mean, you can see, the downtown and Augusta, and you can see, that's ultimately the route that expansion's gonna naturally take place.
Yep, correct. And really what they do also at the strategic level is they work both sides of the equation in the development of the space. So they identify these areas exactly as Chris said, and they start talking to the home builders. Those are the people that are actually going to builder homes on the space about acquiring the land off them, or having an option to acquire the land. And this is how Walton works in these phased takedown that I talked about earlier. So they sign a letter of an offer letter where the builder promises to buy essentially in a phased takedown, take the land off them. But at the same time, they also work with the municipality or the local council or the local authorities, once they've identified the tract of land, to say to them, how does it fit into the master plan in this area? And as you can see, and as Chris exactly says, the growth is down these travel nodes. And at the moment, there's already Highland Springs, a development project that's been approved, sort of across the motorway there. And this Kellogg is just across the way and in the phase of getting it done. There's a high school that's been put in place, all the kind of property stuff that you need, not far away from downtown shopping, all of those type of things. And there's a new medical center, as you can see, all of these things, public safety, healthcare. It's under construction already, so ground has been broken. What happens is they sign an option agreement, and in this case, an option agreement has already been signed. It got signed in February of 23 of this year. It got signed with D.R. Horton. If you go and look on the internet, they're one of the largest home builders in the US. They actually built over 80,000 homes last year. They listed their top 100, just outside the top 100 in the Fortune 500. So, you know, it's not a mom and pop builder with 2 or 3 people helping them out. You know, these are listed entities that are wanting to develop the land, build the homes, and they have a phase takedown, which is the next slide that I'll explain. And this is where we get into this internal rate of return and the return on your money, and the uncorrelated return from a investment perspective. So this is quite a busy slide. What's that?
Some big words there, my friend.
Yes, they were some very big words. So let's just go simple and say money in and money out, and then how much money you make or how much money you get on return of your investment. And that's the easy one to do. So these are the long ones. They're phase takedown, all of this kind of stuff at the top here. The phase takedown just means essentially that D.R. Horton are going to pay over a period of time for each lot or each number of homes that they're going to build annually. Instead of paying for the full amount up front, as they build them, they'll draw down on the lot and pay the money across. So the good way to do it is give an example of someone who puts in $100,000, just so that it's an easy maths and just basic assumptions. So here's the $100,000. This gets invested in this year, 2023, and there's already that signed option agreement. So it's already been signed. There's no discussion about whether or not this land is going to be taken down. It will be taken down, and the first phase of the takedown is going to happen at the end of 2024. And really, it's shown here in this line. They will pay circa $1 million across, and that means every person who has the land title deed of their 100,000 are going to receive $9,000 back next year. And it's very easy to see that all that happens is each time there's a takedown, each time there's a number of plots or land taken by D.R. Horton of this parcel of land that you've bought, you receive cash flow back to you. So 2024, 2025, 2026, 2027. So within 3 to 4 years, you've essentially almost got all of your money back. Okay. And then what happens from that year onwards, these are the really good returns that we get over the period from an internal rate of return perspective. In 2028, you'll get 30,000, 2029, 23, and the final year of the phase takedown and the build, you'll get 76,000. So in the table, it's fairly straightforward. 100,000 in over the cash flow period, you're getting about 219,000 back approximately. And again, as I said, in simple terms, you've over double your money, got over double your money back during that period. And the simple maths is to just divide it by the number of years type of thing to get a return that you would have got each year. And essentially that's what they call the internal rate of return of circa 17.4%. So that's how that works. And I think I'm going to ask my colleagues to jump in and Des, I know you're also running questions from the inbox. I haven't had time to have a look at that. I don't know if you had any there, if we need to explain any more around this slide, but it's a fairly straightforward one.
There've been a couple on this one. What is the likelihood of the IRR not being met?
Very good question. There's always in life, there's three things: death, taxes, and well, there's only two things that are certain. Of course, these are projections, and they are based essentially they're based on the track record that both the home builder and Walton have had over a period of time, over the previous projects that they've been running in the last 10, 15 years. So yes, there is no guarantee that this is the exact return that that the client will get. In instances, and it works both ways. Interestingly enough, on quite a few of the projects, the initial projected IRR has ended up being lower than was actually returned to the investors. And the way that works is the market, they're not sure from a price perspective of the actual end home that they're selling, and really there may be a decent increase in the area, in the cost of the costs may go down for building the house. So there are some various factors that affect that IRR. So it's a great question, but they're fairly confident that it will be, and as I say, it can't be guaranteed, but they're fairly confident that based on the cash flows and a worst case scenario for price being the worst price that they can build at, that they're going to get this type of return. But as I say, in other instances, they've actually had a better return on the investment from the takedown.
Quite frequently that actually, they do shoot quite low with their
Correct.
estimations and their sort of predictions. So actually more often than not, it's higher. And also say, Walton, I mean, this is one example of, one of the land opportunities in the US, but they have quite a few running right now. And some, some will be different. There'll be a shorter, investment period, maybe 3 or even 4 years. Some will, pay out, a bigger proportion of the capital earlier, and then you get smaller amounts. So it can change. I had a client recently where we got a 21% IRR. So, there's some, real good things coming out of Walton right now.
Yeah.
I think
Perfect.
I think if I can jump in there, they've actually got a really great track record, as both Adrian and Chris were just saying. They have outdone their IRR. I think 90% of their developments, and then just met the IRR with the others. But I'll go back to question asking.
Okay.
Okay, next question on that one, Adrian. What is the minimum investment into Walton?
Yeah, it's a great question. The minimum investments, you can correct me, but I think the minimum investment's $50,000 that needs to be done from an investment perspective. It is a great question. So really, from Walton's perspective, everyone's perspective, the minimum they require is a $50,000 investment. So that's a good question.
Perfect. I can't see another one at the minute. Maybe let's go to the next slide.
Yeah, let's move on, and if they pop in, we'll jump back there. We can move backwards and forwards. Right, so that's the land offer, and essentially the land offer in the US. It happens to be a country-specific thing that we're moving, so now we move across the pond, as they call it, to one of our other providers called Acorn, and the same format's going to happen. I don't know who's going to take it, who am I throwing? I've talked Walton, so someone else can talk Acorn.
Well, then.
Is it you, Chris? Great. Okay. Over to you.
Yeah, so slightly different, this one. This is a more fixed term, fixed return investment. So it's a UK corporate loan note issued from a huge property builder within the United Kingdom. Acorn, one of the biggest nationally, but certainly in the southwest of England, which is where they do a lot of their work. They are the largest house builder actually in the southwest. So you can see there they cover sort of Somerset and Bath, Bristol, Cornwall, Devon, typically. Used to do building in London, but not so much now. You know, they're looking at the, you know, the
Developing
not
areas.
level or even mid level property in the UK. They're looking at more the sort of top end, if you like. Not the top end, you know, central London, but you know, certainly individuals that are probably 2, 3, you know, rungs up the ladder, if you like. You know, looking at, you know, your typical sort of 3-bedroom, 4-bedroom detached properties. Yeah, it's very simple investment. You know, we're investing into Acorn. They give us a loan note. 2 years later, they will give us the capital back plus a set return. If we're prepared to defer the interest for 2 years, then you get your capital with 24% return. Or we can take a semi-annually coupon of 5% every 6 months, so getting 10% a year, obviously 20% over the 2 years. Yeah, again, you know, a company with a great track record, you know, and a very well-established company. Again, we're not dealing with, you know, new companies, small builders. You know,
they've also been involved in business over 20 years. Yeah. So.
Yeah, I think if I can sort of jump in there as well. I mean, the way that it's structured, you can see that there is that credibility. You know, being that they've been around for 27 years, the fact that they've got that sort of senior loan from the bank, and then the mezzanine level, which is essentially our investors, and then their equity thereafter. Sorry, Adrian, we're making you jump between slides.
Yeah, I'm moving them all over on, but it's fine. I'm good. I'm a good MC. I'm listening and I'm moving as you talk.
You just go through that, Adrian, because I can't really see that slide. If you can
give it talk.
And then numbers.
No, that's no problem. So, I mean, I think this is just a typical way that they explaining the funding. So, if they have a loan, if they have a build that they want to build, and one of their example builds being St. Leonard's or whatever it may be, something like this, where they building houses over a certain amount of phases, they need the capital to build and obviously build the houses, buy the land, and do everything that they need to do with it. So essentially in this example, and it varies per build, but essentially from a 10 million gross development value, they're expecting to make 12 million, so about 20% of the cost or profit is what they'll make. And this little pie chart just explains the way they get their financing, and really they get about 65% from standard bank funding. That would be like ourselves, like retail. If we went to the market, we went to our bank and said, please lend us some money. So they do that. There's some mezzanine financing of about 1.2 million. And the mezzanine is private investors. And that's where this fits in for us and for our clients. This is where it's a structured loan note. And that structured loan note pays out consistent and verified and guaranteed returns. But we'll get to that slide and that breakdown around the two options that you can do. Chris just gave the overview, but I'm going to throw him under the bus again and ask him to just do that a lot slower for the clients.
You know, I think that, you know, and I get asked this quite frequently, you know, why do, you know, companies do this? You know, why do they need my money? You know, why, how even, you know, they pay me 24%. And you've got to really rewind back to, you know, sort of 2008 and the financial sort of crisis. You know, companies like Acorn typically then, you know, could go to a bank with a proposal for a development, and, the bank would give them, 90, 95, 100% of, the capital that was required. Those days, have long gone, and typically they can only raise, as you put there, I think about 65, 60% sometimes even, and they need capital. A lot of these companies have huge assets, but, being able to, use other financing to do this, and not, really does help them. It's huge for them. From a security point of view, all of the, we get offered, hundreds of different, loan notes from various companies. It goes through very rigid due diligence from our investment committee. And we only have, a very small amount of companies that, we work with. And this is one that, we're very, very comfortable with. They're a huge company. We have a FCA regulated trustee that, holds the funds. We have floating debentures and security across all assets and, bank accounts. The assets that, they hold far outweigh, what they owe in terms of, loan notes. So yeah, from a peace of mind and comfort for our clients, as Adrian said, nothing in life is guaranteed, nothing. But this is about as close as
you can get. Yes.
Great way of adding, further diversification to your portfolio. I think anyone that's had money in the markets over the last, 12 months will have been horrified at, the value right now of their portfolio. Now, we know that markets will always recover, and, we're going to see some great returns at some point, but I think there's still a lot happening in the world right now that's still going to add, further volatility to the market. So it's not saying don't be in the markets, but it's a great way to just, have that fixed, fixed return, coming in. I think, it should form, an integral part of, a good balanced portfolio right now.
100%. And I think, the certainty of the returns helps, the capital, backing by the company and all those things. And you raced over the actual returns. So I'm going to now put up the slide. I hope it's not too small.
I'm talking about good things, Adrian, not boring.
No, these are, and these are good things. That's why I want to slow it down now and put it up, and you must talk about it and exact cash flows.
2 years, they give us 24%.
Yep.
Job done.
Yep.
Okay, so let me jump in here and be a little bit more rigid. Okay, so essentially what we're saying is if you are taking an income from this asset over the 2-year period, that quarterly you're going to receive £2,500.
Yeah, my apologies. Actually, it is quarterly and not semi-annually. I think I said semi-annually. Sorry.
You did.
You did, but it's just because of that other one.
But it's if you need income to live off and you need that certainty of, how much, you need to live off, what a great way of being able to do that.
Correct.
Yeah. And then if you are happy to wait for the interest, the return on that amount, then the deferred income is essentially 12% per annum, 24% at the end of your 2-year term. So, I was just about to ask the question that came up here, but it's right there for everybody to see.
Okay.
The minimum investment of £20,000.
I should have hidden it away. Yes.
Yeah.
I said that before. Yep.
Okay, so
I
that's
think the
that's
one, can I jump in as well, just quickly on this
Yeah.
example? I mean, it is fairly straightforward, but I do get asked, or we do get asked quite a bit about it on the interest and then this internal rate of return, back to those acronyms, and compound interest and all of those type of things. This in the financial jargon is pure simple interest return. So simple interest is actually one of the easiest calculations to do. It was what I gave the simple interest example in the internal rate of return calc, because the IRR calc is very complicated. But essentially here, as Des said, from a return perspective, the 10% per annum is pure 10% times the money that you put in. And in this example, it's 100,000. So 10% gets paid out to you every quarter. There's 2.5. You do the maths. 10,000 gets paid in the first year, and then another 10,000 in the second year, plus the return of your capital in month 24. And the enhancement, and I nearly said sweetener, but if you want to just defer the capital or defer the repayment of any interest, you can do that, and they enhance the loan note by pure 2% uplift, if you like. So at the end of that term, you'll receive 24,000 versus in this example, you would have only received 20,000, but the cash flow comes to you. And it's a fixed term for 2 years. So that's also important for clients to understand. Certainly, we'd never allow massive amounts of money to go towards this. As Chris mentioned, it's a lovely pillar for diversifying in a balanced portfolio. And it is 2 years. So it's essentially no requesting of any money back or anything, or any of the capital. It is a 2-year loan note. The term is 2 years from when you hand it over. And you have a title. So it's another question a lot of people ask around this. There is a title deed, and that's issued in your name. And as Chris talked about from a securities perspective, there's debentures and a security trustee and all of those type of things. Okay. I think that might be it.
The serious stuff. We always stick you with the serious stuff, don't we?
Yeah, I know, I do. I wanted some fun stuff rather at some stage, but maybe there's some questions, and I think let's just see. Maybe while you think of or look through the questions, I'll also see if I can look through the poll to see if I've got any answers for the poll.
I think just one final thing for me. It's, everything that we do as financial advisors, really is about that, medium to long-term, financial planning. And although there is a slight deviation from that, just being typically a 2-year investment, a lot of clients, if you can, if you've got $100,000 right now that, we don't need to touch for the next, 10 years, by putting into this and just keep reinvesting it, when we factor in the compounding of that, I mean, it's huge, over a 10-year period, you're probably, $300,000 from your 100,000, so.
Correct.
Yeah, it's an incredible way of building wealth.
Yep. And it's to add to that, there's a client, looking, and it's the kind of thing we do exactly that. They have a young son or daughter, and there's a 10-year horizon to putting them through tertiary education. An allocation of a lump sum now. Let's even say the 20,000, the minimum amount, and exactly as Chris said, you just let that roll for the next 10 years. You'll certainly have enough money to put your child through whatever education or whatever institution they want to go to. So a great way to do it.
Very much so.
I think from a time point of view, I think any other questions we can respond directly to. I think we've kept people long with us. I think we've probably bored them by now. So I think should we wrap up? And we
can. That's it.
If anyone is seriously interested in having a conversation, just reach out. We can set up individual meetings, one-to-one over Zoom. But other than that, have a wonderful afternoon, I'm guessing now for most people. I don't think it's morning anywhere.
Morning.
Still, I think, but yeah. Anyway, have a great day, and we'll see you all next time.
Couldn't have said it better.
Cheers
Thanks.
all.
Thanks, Chris. Bye-bye to everyone. Cheers.
Bye.